morning friends, welcome to The Point. In this video, we'll try to understand a small facility that is being provided by central banks to the commercial banks for borrowing money, which is called Marginal Standing Facility. So now let us start with it by understanding its definition first. Marginal Standing Facility is provided by Reserve Bank of India, which is the central bank, to scheduled banks. So now first you'll understand what's this scheduled bank. Scheduled banks are the banks mentioned in the second schedule of RBI Act 1934. Okay, so all those banks which are listed in the second schedule are eligible to avail this facility, so to borrow for overnight purpose. So this facility is provided by RBI to the scheduled banks for borrowing for overnight purpose. So what is overnight? It's just one day. Okay, it is resorted to when all other sources for borrowing have been exhausted by the banks and their liquidity in the interbank market have dried up. So what this bank does to match their liquidity level or to maintain their CRR or SLR ratios, they first resort to interbank borrowing. Let's suppose there are two banks, HDFC and SBI, and now HDFC is falling short of money to maintain its CRR for the day. So now the first place where it will go is to the other banks. It could be SBI, it could be ICI, or could be any other bank. This is what is called interbank borrowing. And when let's suppose it has tried all other banks and all of the resources and it cannot fetch money for itself, it will approach RBI for lending it money for overnight purpose so that it could maintain its CRR or whatever ratios it has to maintain. This facility was launched by RBI in 2011-12 while reforming its monetary policy. So I hope the definition is clear. When a scheduled bank, a bank which is mentioned in second schedule of RBI Act, wants to borrow and that bank has exhausted all the resources of borrowing for overnight purpose, so it approaches RBI and this facility is extended by RBI to these banks. Now something more about this marginal standing facility. So first is the lending mechanism. For borrowing money, the banks have to pledge their government securities with RBI. So it is not that the bank approaches the RBI and it can take the money it wants to. No, it has to pledge some government securities, and only if government securities are there with the bank, only then it can avail money from RBI. Now the rate of interest, obviously when you borrow some money, you have to pay certain rate of interest over it, which is 1% or 100 basis point above the repo rate. I hope all of you are aware of this fact that 1% is equal to 100 basis points. So if we talk about 2%, then it would make 200 basis points, and it goes on like this. So if we say 0.5%, so it is 50 basis point. So the rate of interest charge on this MSF facility is CRR plus 1%. So that is the interest rate which central bank charges from the scheduled banks for borrowing under this mechanism. Now there has to be a lot size, that is the minimum borrowing amount which a scheduled bank should borrow or can borrow from RBI, which is rupees 1 crore and its multiples. Only the multiples of it can be used. It could not be like 1.5 crore or say 2.5 crore. No, it has to be multiple of 1 crore. Next is the borrowing limit. So it is not that the banks can borrow endlessly or any amount from the central bank. Earlier it was 1% of NDTL. So now what is NDTL is net demand and time liabilities, but now the limit has been increased and it is now 2 to 3% of their net demand and time liabilities. Now I'll explain what is this NDTL. There is many types of deposit that comes with the bank. So there is demand deposit, that is what is called DD, and there is time deposit. Now these demand deposits can be withdrawn upon the request of the customer. There is no foundation or there is no fixed lock-in period for these demand deposit, whereas the time deposit, which is the other name is fixed deposit or the recurring deposit, there is certain lock-in period for this. So how do we come at this figure of NDTL? Now what you have to do is you have to add your demand deposit, your time deposit, minus what you have to subtract is the interbank deposits. Let's suppose there is HDFC Bank and it has deposited some amount with the ICI Bank. So you have to reduce that amount, that is interbank deposit, and the figure that comes is NDTL. So this is your net demand and time liabilities. Now 2 to 3% of this amount can be borrowed by the scheduled banks from RBI. What is the tenor of borrowing? As I said, it's just for overnight or 1 day. So something more about MSF. It is the eligibility, who can borrow. Is that the scene that any bank in the country can borrow? No. The banks whose name appear in the second schedule, as I told you, of the RBI Act 1934 are, and also having current account with RBI, are eligible to participate in this MSF scheme. Discretion of RBI. So it is not that any bank mentioned in the second schedule approaches RBI and RBI is bound to give. No, RBI is not bound to give whenever any bank approaches. It can act on its discretion, which means that it can either accept the demand or reject the demand to lend the money to the respective bank. Now, as I told, that there is certain security or the collateral which the bank has to provide it to RBI in order to take money. So what are the securities which form the part of it, or what are the eligible securities that can be given as collaterals? So there could be the dated or securities of the government, the treasury bills, and the state developmental loans, the papers of it, right? So that could be pledged with RBI. Also, one thing to be noted over here is that those securities which are eligible to be pledged under statutory liquidity ratio are used here for the overnight borrowing. So there is a ratio which the banks have to maintain, and that could be maintained, if you remember, in cash, gold, or the G-Secs, which is the government securities. So the G-Secs which are used or are eligible under this SLR mechanism can be used here also. I hope, my dear friends, that the concepts relating to marginal standing facility are clear, that what is this facility all about, which all banks are eligible, what amount can be taken from RBI, what all has to be pledged to get that amount, what is the duration, and what is the interest rate charge. So I hope this video adds little to your knowledge. This is all for today's video. Thank you so much.